You know what I find fascinating about recessions? Everyone treats them like they're disasters that destroy wealth across the board. They panic, they sell everything, they hide under their beds waiting for the storm to pass. But that's exactly backwards. Recessions don't destroy wealth. They transfer wealth from the unprepared to the prepared, from the emotional to the rational, from those who panic to those who plan. I've lived through 8 recessions in my 40-year career. The early 1980s double-dip recession, the 1990 to 91 recession, the 2001 dot-com recession, the 2008 to 2009 financial crisis, the brief 2020 pandemic recession, and several smaller downturns. And in every single one, while most people were losing money, some people were making fortunes. The difference wasn't luck or timing, it was preparation and understanding which assets actually thrive when the economy contracts. Most people think of recessions as periods when everything goes down. Stock prices fall, real estate values decline, businesses fail, unemployment rises, and all of that is true. But what they miss is that while some assets are falling, other assets are rising. While some businesses are failing, other businesses are thriving. While some people are struggling, other people are capitalizing on the opportunities that only exist during periods of economic stress. At JPMorgan Chase, we've made some of our best returns during recessions, not despite the recession, but because of it. We acquired Bear Stearns during the 2008 crisis for $2 per share when it had been worth $170 per share just a year earlier. We picked up Washington Mutual's assets for $1.9 billion when they'd been worth tens of billions. We expanded our market share, strengthened our competitive position, and positioned ourselves for the recovery that we knew would eventually come. The next recession is coming, they always do. Economic cycles are as predictable as seasons. Periods of expansion are followed by periods of contraction, periods of optimism are followed by periods of fear, periods of easy money are followed by periods of tight money. The only questions are when and how severe, and given where we are in the current cycle with inflation elevated, interest rates rising, debt levels at record highs, and geopolitical tensions increasing, I'd say the next recession isn't a matter of if, but when. I want to tell you about 4 specific assets that not only survive recessions, but actually thrive during them. These aren't theoretical concepts. These are assets that have outperformed during every major recession of the past 50 years. Assets that provide both protection from downside risk and opportunity for significant upside returns when everyone else is losing money. The first asset class that thrives during recessions is what I call safe haven assets, but I'm not talking about the obvious ones that everyone mentions. Yes, treasury bills and government bonds do well during recessions as investors flee to safety and interest rates fall, but the real opportunity is in high-quality corporate bonds from companies with strong balance sheets that are trading at distressed prices due to credit market panic. During every recession, credit markets seize up. Investors become terrified of any credit risk, even from companies that are fundamentally sound. This creates incredible opportunities to buy bonds from high-quality companies at yields that would be impossible to obtain during normal economic conditions. We're talking about companies like Microsoft, Apple, Johnson & Johnson, companies that aren't going to default even in a severe recession, but whose bonds trade at distressed levels because of market panic. Let me give you a specific example from the 2008 financial crisis. In late 2008, when credit markets were completely frozen, you could buy bonds from Warren Buffett's Berkshire Hathaway yielding over 8%. Berkshire Hathaway, one of the strongest balance sheets in the world with over $100 billion in cash, was paying 8% because credit markets had completely broken down. Those bonds not only provided that 8% income, but appreciated significantly in value as credit markets normalized. The same pattern played out with dozens of high-quality companies. McDonald's bonds were yielding 7%. Coca-Cola bonds were yielding 6%. These weren't distressed companies. These were some of the strongest franchises in the world, but their bonds were priced as if they might default because investors had completely lost their appetite for credit risk. During the 2020 pandemic recession, the pattern repeated itself. When markets crashed in March 2020, high-quality corporate bonds sold off dramatically, even though many of the underlying companies were in excellent financial condition. Technology companies, healthcare companies, consumer staples companies, their bonds were trading at yields that hadn't been seen in years, creating incredible opportunities for investors who had the courage and the cash to buy when everyone else was selling. The key is focusing on quality. During a recession, credit quality matters enormously. You want bonds from companies with strong cash flows, low debt levels, essential products or services, and the financial strength to weather an extended downturn. Avoid anything speculative or highly leveraged. This isn't the time to reach for yield most. This is the time to prioritize safety and take advantage of the fact that high-quality credit is trading at distressed prices. The second asset class that thrives during recessions is what I call crisis opportunity companies. These are businesses that actually benefit from economic downturns, either because their business models are recession resistant or because they gain market share when competitors struggle. Discount retailers are classic recession winners. During the 2008 financial crisis, while most retailers were struggling, Walmart stock was up 20%, Dollar General was up 25%, Costco outperformed the market significantly. Why? Because when consumers are under financial pressure, they trade down to lower priced alternatives. They shop at discount stores instead of department stores. They buy generic brands instead of name brands. They focus on value rather than luxury. This pattern has been consistent across multiple recessions. During the early 1990s recession, Walmart expanded rapidly while other retailers retrenched. During the 2001 recession, discount retailers again outperformed. During the 2020 pandemic, essential retailers like Walmart, Target, and Amazon saw massive growth while traditional retailers struggled. Another category of crisis opportunity companies is what I call fix-it businesses, debt collection agencies, bankruptcy lawyers, restructuring consultants, distressed asset buyers. These businesses see their revenues spike during recessions as more companies and individuals need their services. During the 2008 crisis, debt collection companies saw their stock prices rise as loan defaults increased. Bankruptcy law firms saw their revenues double or triple. Distressed asset funds raised record amounts of capital. Pawn shops and payday lenders, while controversial, are another category that sees increased demand during recessions as people need access to quick cash. Gun manufacturers often see increased sales during periods of social and economic uncertainty. Home security companies benefit from increased crime rates that often accompany economic downturns. At the institutional level, companies that buy distressed assets can generate enormous returns. During the 2008 crisis, private equity firms and hedge funds that specialize in distressed investing made fortunes buying assets from banks and companies that were forced to sell at fire sale prices. Real estate investors who had cash available could buy properties at 30% to 50% discounts from their peak values. The key with crisis opportunity companies is understanding the specific recession dynamics that drive their business. Some benefit from consumer trading down, others benefit from increased financial distress, others benefit from the general uncertainty and disruption that recessions create. The important thing is to identify these opportunities before the recession hits, when their stocks are still trading at normal valuations. The third asset class that thrives during recessions is defensive infrastructure investments that provide steady cash flows regardless of economic conditions. These are assets that people and businesses need to use whether the economy is strong or weak, and they often have pricing power that allows them to maintain or even increase revenues during downturns. Utilities are the classic example. People need electricity, gas, water, and telecommunications services regardless of whether the economy is in recession or expansion. These are essential services that can't be postponed or canceled. During the 2008 financial crisis, while the S&P 500 fell over 50%, utility stocks were down only about 20%. During the 2020 pandemic, utilities were actually positive while most other sectors were negative. But I'm talking about more than just traditional utilities. Cell phone towers, for example, provide critical infrastructure that becomes more important during recessions, not less important. During the 2020 pandemic, as everyone worked from home and relied more heavily on digital communications, cell tower companies saw increased demand and rising revenues. American Tower, Crown Castle, and SBA Communications all outperformed the market significantly. Data centers are another example of defensive infrastructure. As the economy becomes more digital, data storage and processing becomes more essential, not less essential, during recessions. Companies might cut spending on travel or marketing, but they can't cut spending on the digital infrastructure that their businesses depend on. During both the 2008 and 2020 recessions, data center companies continued to see steady demand and rising revenues. Toll roads and airports are interesting cases because they combine essential infrastructure with recession sensitivity. People still need to travel, but they travel less during recessions. However, many of these assets are structured as monopolies or near monopolies with regulated rate increases, so they can maintain pricing power even when volumes decline. The best airport and toll road companies actually emerge from recession stronger because they use the downturn to invest in improvements that increase their competitive advantages. Storage facilities, particularly self-storage, are another defensive infrastructure play. During recessions, people downsize their homes but still need places to store their belongings. Businesses consolidate office space but still need storage for inventory and equipment. Divorce rates increase during economic stress, creating demand for temporary storage. Self-storage companies typically see occupancy rates remain stable or even increase during recessions. The key with defensive infrastructure is focusing on assets that provide essential services with high barriers to entry and pricing power. You want infrastructure that people and businesses have to use, not just choose to use, and you want infrastructure with monopolistic characteristics that can maintain or increase prices even when demand softens. The fourth and final asset class that thrives during recessions is precious metals and commodities, but not for the reasons most people think. It's not just about inflation protection or currency debasement, though those factors matter. It's about the specific supply and demand dynamics that often favor commodities during and after recessions. Gold is the obvious starting point. Gold typically performs well during recessions for several reasons. First, it benefits from the flight to safety as investors move away from risky assets. Second, it benefits from lower real interest rates as central banks cut nominal rates to fight the recession. Third, it benefits from currency debasement as governments print money and run large fiscal deficits to stimulate the economy. During the 2008 financial crisis, while stocks fell over 50%, gold was essentially flat, providing crucial portfolio protection. But more importantly, gold continued to rise for several years after the recession ended, reaching all-time highs above $1,900 per ounce as investors worried about the long-term implications of the massive monetary and fiscal stimulus that was used to fight the crisis. During the 2020 pandemic, gold again provided portfolio protection during the initial crash and then continued to rise as the Federal Reserve cut rates to zero and expanded its balance sheet by trillions of dollars. Gold reached new all-time highs above $2,000 per ounce as investors sought protection against currency debasement and financial system instability. But gold isn't the only precious metal that benefits during recessions. Silver often outperforms gold during periods of economic stress because it has both monetary properties and industrial applications. During recessions, silver benefits from the same flight to safety dynamics as gold, but during recoveries, it benefits from increased industrial demand as economic activity picks up. Beyond precious metals, certain commodities can thrive during recessions due to supply disruptions or strategic considerations. Energy commodities, for example, often benefit from geopolitical instability that accompanies economic downturns. Agricultural commodities can benefit from weather disruptions or supply chain problems that are exacerbated by economic stress. But the real opportunity with commodities during recessions comes from the fact that commodity producers often cut production dramatically when prices fall, setting up supply shortages for the recovery. Mining companies shut down high-cost mines, oil companies cancel drilling projects, agricultural producers reduce plantings. This creates the foundation for commodity price increases once economic growth resumes. During the 2008 to 2009 recession, copper prices fell from over $4 per pound to under $1.50 per pound, but commodity producers responded by shutting down high-cost production, and when economic growth resumed, copper prices quickly recovered and eventually reached new all-time highs above $4.50 per pound. Oil followed a similar pattern, falling from over $140 per barrel to under $35 per barrel, but then recovering strongly as economic growth resumed and producers had insufficient capacity to meet demand. The key with commodities during recessions is understanding the specific supply and demand dynamics for each commodity. Some commodities have defensive characteristics and hold up well during recessions. Others get crushed during recessions, but set up for strong recoveries. The important thing is positioning yourself to benefit from these cycles rather than being victimized by them. Now let me bring all four of these asset classes together and explain how to construct a recession-resistant portfolio that can not only survive the next downturn, but actually thrive during it. The key is understanding that these assets work best in combination, not isolation. They provide different types of protection and different types of opportunity. Safe haven assets provide stability and income during the chaos of a recession. They're your defensive foundation that allows you to stay calm and rational when everyone else is panicking. High quality corporate bonds trading at distressed yields can provide both current income and capital appreciation as credit markets normalize. Crisis opportunity companies provide growth potential during the recession itself. While most businesses are struggling, these companies are actually benefiting from the economic downturn. This is where you can make money, not just preserve money during the recession. Defensive infrastructure provides steady cash flows that are largely independent of economic conditions. These assets allow you to maintain income even when other dividend-paying stocks are cutting their payouts. They also provide inflation protection and tend to outperform during the recovery. Precious metals and commodities provide protection against the currency debasement and fiscal irresponsibility that typically accompany efforts to fight recessions. They also position you to benefit from the supply shortages and inflation that often follow recessions. The specific allocation depends on your risk tolerance, your investment horizon, and your other sources of income, but a recession-resistant portfolio might look something like this: 30% in safe haven assets, including high-quality corporate bonds and treasury securities, 25% in crisis opportunity companies, including discount retailers and distressed asset buyers, 25% in defensive infrastructure, including utilities and essential services companies, and 20% in precious metals and strategic commodities. This isn't a buy and hold forever allocation. As economic conditions change, as the recession unfolds, as recovery begins, you need to adjust the portfolio to reflect changing opportunities. During the depths of a recession, you might want more safe haven assets in crisis opportunity companies. As recovery begins, you might want to shift toward defensive infrastructure and commodities. The crucial thing is to start positioning yourself before the recession hits. By the time everyone agrees that we're in a recession, it's too late to get the best positioning. You want to be buying these assets when they're still reasonably priced before the recession premium gets built into their valuations. And remember, recessions create some of the best long-term investment opportunities you'll ever see. The companies and assets that you buy during a recession will often generate your best returns over the following decade. This isn't just about surviving the downturn, it's about positioning yourself to thrive during the recovery in the next expansion phase. The next recession is coming. The question isn't whether you'll face it, but whether you'll be prepared for it, whether you'll be one of the people who transfers wealth from the unprepared or one of the people who transfers wealth to the prepared. The choice is yours, but you need to make it now while these assets are still available at reasonable prices and while you still have time to build a recession-resistant portfolio. Because when the recession hits, when markets are crashing and everyone is panicking, it will be too late to implement this strategy. You need to have these positions in place before the storm arrives so that when everyone else is selling, you can be buying. When everyone else is panicking, you can be profiting.